Hello everyone! Our topic for today is changes in equity. Objectives. At the end of the lesson, the learner should be able to number 1. Know the meaning of equity. Number 2. Know the elements of changes in equity. Number 3. Enumerate the factors that affect changes of equity. Number 4. Purpose of knowing changes in equity. Are you ready? Let's get started. What is the meaning of equity? Equity, also called net assets, is the owner's claim to company assets after the liabilities are paid off. How to calculate equity? The equity of a company can be calculated by subtracting the company liabilities from the company assets. This is why equity is commonly referred to as net assets or residual equity. Example: if someone owns a car worth $24,000 and owes $10,000 on the loan used to buy the car, the difference of $14,000 is equity. Almost every business holds equity in something or someone outside of itself. This might be in the form of loans, stocks, or investments. Understanding equity will help you make more educated on financial decisions for your company. What are the elements of changes in equity? Changes in equity covers the following elements: net profit or loss, dividend payments, and equity withdrawals. Net profit or loss. It is the difference between the gross profit or loss and the total indirect income or expenses of a business. If the difference is a positive value, it's net profit, and if the difference is negative, then it's net loss for a business during a particular accounting period. Dividend payment. Dividend payment. It is the distribution of a company's profits to its shareholders. Dividends are usually paid in cash, but sometimes in company stock, and companies often use them to return excess profits to investors. Owner's withdrawal. It is a contra-equity account. This means that it is reported in the equity section of the balance sheet, but its normal balance is the opposite of a regular equity account. Because a normal equity account has a credit balance, the withdrawal account has a debit balance. What are the factors that affect changes in equity? Equity can be affected by the factors like dividend per share, the market value of the share, dividend growth rate, beta, risk-free return, and expected market return. Dividend per share. Dividend per share indicates the distribution of profit of the firm as compensation for an equity share held by an investor. If the dividend per share for the upcoming year increases, keeping the other factors constant, the cost of equity will increase. Current market value of the share. The price at which a company's stock is traded in the market is one of the factors that determine the cost of equity. Assuming other factors remain constant, the higher the market value, the lower is the cost of equity and vice versa. Dividend growth rate. Dividends represent company profits that are paid to shareholders. When a dividend increase is the result of improved cash flows, it is often a positive indicator of a company performance. Another reason for a dividend hike is a shift in company strategy away from investing in growth and expansion. Beta. Beta reflects the changes in the price of the stock relative to the changes in the market. One can easily find beta online, or it can be calculated using regression. A beta greater than 1 reflects more volatility of stock as compared to the market, and vice versa. If beta equals 1, the stock is volatile as the market. Lower the beta, lower will be the cost of equity, and vice versa. Risk-free of rate return. The risk-free rate of return is the rate of return on minimum or negligible risk investment. Return on treasury bills is considered for calculating the cost of equity. The higher the risk-free rate return, the higher will be the cost of equity, and vice versa. Expected market return. The return the investors expect based on the ideal index performance is amongst the factors affecting the cost of equity. The higher the expected market return, the higher the cost of equity, and vice versa. Purpose and importance of knowing changes in equity. It shows if the business owner needs to invest more capital to cover shortfalls, or if they can draw more profits. It is also used when making business decisions, such as expansion and diversification. It is an essential aspect of business, finance, and investing. Among other things, equity is vital for determining how a company will be valued by its investors and how it will provide information about its business to potential investors. It also aims to identify and eliminate barriers that prevent the full participation of some groups. Thank you for listening. That's all for today.